You're live, Caroline. Remove. There we go. Got a little technical difficulty there. Good afternoon, everybody. I think I'm on now. Going to fire that producer later. No, I can't. I'm married to her. I can't get rid of her. I love her too much. Thanks, Caroline. She goes, don't ever say my name. Don't ever, bring me into this. Don't ever do it, And here she did it to herself by clicking that button. You got to see you live on Facebook, YouTube, and every other place on the planet and the universe. So anyway, that's Caroline. She does a great job. Anyway, welcome to Mortgage Madness with Mike Hobbs. I'm Mike Hobbs. I'm your host. Hey, welcome. Thank you for tuning in today. Without you, I do not exist. This show doesn't go on. It's meant for you. It's meant to bring some quality information to you. Have some fun doing it. Be controversial a little bit too, but really give you what you want. I'm wearing glasses today because I'm in a different setting. If you watch the show, you usually know I'm in the studio or background in my office or what have you. Here I'm at home. I'm at home because as you can see out that window, right there it is, that window behind the snowman, you'll see that it's snowing. It's a snow day. The schools are canceled today. And we're supposed to get like 10 inches or 12 inches of snow or more. I don't even know. It feels like a lot more than that. I was out blowing snow just a few minutes ago. My hands are still warming up a little bit. So I was wearing this and I'm staying warm on top of my head because I've got thinning hair. So it's a beautiful day. We're in Coeur d'Alene. So just so you know, it's Coeur d'Alene, Idaho, and it is snowing. Beautiful, a lot of snow, and the roads are treacherous and slippy. So be careful if you're local. And if you're not local, you're somewhere else sunny, like in Camarillo, California, where I hail from. I've talked to a few folks from there today, and it's nice weather out there. Well, anyway, you don't have to endure the snow. So welcome to Mortgage Madness. Thank you very much, Mike Hobbs. Talk about a few things. We talked about the show, which was date your mortgage, marry your home. So date your mortgage, marry your home. You can always get another rate. You can't always get another home. So when you're thinking about buying, and I know there's a lot of hesitation out there in the marketplace to buy, but don't. Hey, it's still a good time to buy, and rates are coming down. We've been flat for the last 2.5 weeks with the consumer confidence, I think, that was up. So they had, and also it was the inflationary report that came out. It was a little lower than expected, slower or dropped a little bit. And so that caused the bond markets and what have you, the treasuries to move down a little bit, up and down, inverse. And that caused our rates to drop quite a bit. And then they held. They haven't done a lot. I don't know if that's going to continue because it depends on, economic news and what's happening. They may move back up. So I don't expect those, nor do the experts expect that to stay there for long. But who cares? We don't really care. The lower interest rates are great, and we'll take advantage of those now. So if you're out there and you're hunting, hey, give me a call. You can reach me right there at the bottom of the screen, 208-643-2865. All my stats are there. You can get me at my website, which is just my name, Mike Hobbs, and then numeral 1.com. You can find me there and communicate with me there. You can chat here live too as well. Try and pick those up. I'm going to move my chat box open and see what I've got and see if we get anybody chatting. Yep, we got somebody in there. There's Jeff Garrison, Cam Mario. There you are, Jeff. Hey, Jeff, thanks for tuning in. I have not talked to Jeff in a long time. Jeff is with Countrywide. I think, well, he's not anymore. He can't be. He's with Bank of America now, but he was with Countrywide when we were doing business when I was a banker back in the day, and he was. And, man, his company, Countrywide, supported my big mortgage company quite a bit. So love you, Jeff. Thanks for tuning in. And I'll give you a call off the show. I owe you a call anyway. And so you can text there, post on the show, and I'll see your messages. And I'll respond to you if you have any questions for me. And again, Mortgage Madness, we're coming every week. Usually around this time, we started a little late, so apologize for that. Those people that are just listening to me, you can't see the snow or the snowman, but it is snowing. It's cold here. I think we're down in the teens, and it's beautiful. So let's talk about a few things. Date your mortgage, marry your home. You're going to buy a house. You're going to buy the house. The mortgage is going to change. We're going to see lower interest rates in the future at some point in time. We can't sustain this. Our economy just doesn't run well. It starts to fall off the rails, as you can see that on the news anywhere else. So it's just not going to continue. So don't worry about that. But how do we make things affordable is really what we're talking about today. So that's the theme of this. And let's talk about Fed funds. So let's pop that up on the screen real quick if you can. So Fed funds, everybody says, hey, interest rates are going up and what have you. And they always hear this because that's what's announced, and they hear the Fed funds are moving up. And yeah, I think on the 14th, they're meeting again, and they'll probably move them another 0.5%, 3 3/4, 4%. We'll probably be close to 4.5% here coming the middle of December, which isn't directly related to the interest rates or mortgage rates, but they can't have an impact on them. But the interest rates, or I should say the Fed's rate, Fed's fund rate. I can't even say that today. It's cold. I'm snowing. I'm warming up still. But the Fed's fund rates are those rates that are charged between the depository institutions, one bank to another. Credit unions lend to banks, or credit unions lend to other depository institutions that are short on their reserve requirements, and they do that on an overnight balances. If they have surpluses, they lend those to banks that have to get their reserve requirements up to meet the requirements, and they do this back and forth. And so that's really what that impacts. That affects the banking industry a little bit, and then the gears and things that go on behind in the markets. But it's also an indication of how the market's going to react. So indirectly, it can affect our rates, but not directly. So when you hear that rates are rising, you always say, "Well, which rates?" And if you're looking at an indicator that's going to tell you whether the mortgage rates are up or down, it's really going to be the 10-year note. So look for the 10-year note in the bond market. And those are the kind of things that are going to tell you whether we're moving in one direction or another with rates, and they change all the time. So interest rates have been flat. Don't know how long that's going to go. November 10th, the inflation data was the thing that caused that to drop. Don't think it'll continue, but it may be there. Another thing to bring up too is conforming rates. At the beginning of the year, we always have our conforming loan amounts change and move and what have you. And those are going up, and they're already in place now. And I work for Loan Depot. I'm a home loan officer with Loan Depot, and my number is 1804310. That's my NMLS. And there's Loan Depot. Loan Depot is already lending that way, and a lot of institutions are. We'll have our FHA loan amounts coming out soon. VA is always, maximum whatever they uncapped that a couple of years ago, I guess. But FHA is coming out, and that'll certainly be higher depending on the counties. They go by based on the counties. But those loan limits, conforming loan limits, are going to be rising, and they have. And so a lot of institutions are funding with the higher amounts too. So now where you were on that edge possibly of buying and you were getting jumbo pricing, which is more expensive, you can get cheaper conforming. Some product out there with some of the credit unions and some of the institutions I still use through Loan Depot, because I can broker as well. And we find that sometimes they're competitive. We have an array of options to use for you. And we can look to some of those institutions that have those monies that are much cheaper, even when they're in the jumbo category. And we do have that option. So not always does the jumbo today, with this crazy market, mean you're going to pay a higher interest rate, but most of the time it does. Let's talk about how to make things affordable for buying. So I see things posted online all the time from agents and other people too, not necessarily the loan officers so much, because we're reluctant to talk about specifics in that way, but I will. I don't care. I'm kind of that edgy guy. I'll do it. Come get me. We're the mortgage police. There are no mortgage police, right, Jeff? No mortgage police. But I will say that some agents out there are talking about, and people in the industry talk about, getting getting the price of the home down, because in our area, our region up here in the Coeur d'Alene area, Idaho, in the panhandle of Idaho, in this area, we're seeing that prices are dropping, and it's happening around the country. And that's happening in a lot of places because the interest rates are higher. That means less people can buy, and it takes away the buying power. So you shore that buying power, by lowering the price of the home. But what's interesting, when you do that, if you lower the price of the home, and I'm going to pull up a couple of things there. Let's put in the buy down scenario, if you would, on the screen for me. I want to show you this. So here's the monthly payment difference on different types of options. So let's just say that you're going to buy a house, and in this example, let's use a $500,000 sales price, for example, and we use 10% down. Okay. A 30-year fixed, let's say that's the baseline. You're going to get a 30-year fixed at asking price. That's baseline. That's vanilla. Everybody thought that way in past and what have you. Now we need to get a little more creative, but that's baseline. The next stage, which is where, again, we see a lot of these postings where agents are saying, hey, sellers are ripe to be able to negotiate with and get the lower price. And they talk about lowering the price. The difference in savings of $20,000 on a $500,000 home, so dropping the price from $500 to $480, will save you $129 in this scenario. This scenario is using rates from about 2 weeks ago, a little higher than they are now. But nonetheless, let's call it $129 and change. It'll save you. So if you negotiate $20,000 off of a home, and in this case, the $500,000 home down to $480, we're going to save you about $129. If we do a temporary buy down, it will save you $591. Now, this is what everybody secondarily pushes. This is the second option. So the first option I'm hearing, online is, hey, get the seller reduced price, but that doesn't really, it's not enough oomph for you. you get a lot more oomph from the temporary buy down. So the temporary buy down would drop, in this case, it might drop you down, let's say 2 percentage points. So whatever it is. So if it's 6.5, it could drop you down to 4.5, 7.5 could drop you down to 5.5, so forth and so on. So whatever that rate is, that's the standard for the 30-year fix. And you do a buy down, you buy down 2 points, and then it comes up 1 point for the second year. And then it finally comes back up to market price the third year out to the 30th year. But initially you save the difference between a baseline asking price of 500 and no buy downs, but a standard 30-year fixed. You save $591.42 in this example. Let's go over to the next one, which is the fourth option, which is the one I advocate because it's just math. It's not my opinion. It's mathematical. So this is math. This went through analytics that said, hey, here's how this works out mathematically. The math on this is the permanent buy down versus the temporary saves you $451. Not as sexy as the $591 that the temporary does. So first off, when you look at this chart, you're going to go, well, the temporary is the way to go. But remember, temporary, key. It may feel good right out front on the first year, but it's going to catch up and it's going to go all the way back up. That $591 is going to disappear. So on a permanent buy down, we're not going to go as low in the first year. We're not going to save $591. We're going to save $451 a month. So you're still saving $451, but that's forever. It doesn't change. So you're exceeding the 129 of just getting a price reduction of 20. You're not exceeding the temporary buy down in the first year only. The second year you blow it away. In the third year, you wipe it out at $451 of savings. And that's permanent. So do not do the temporary. Do the permanent. The only time, because the temporary doesn't help you anyway, you're qualifying at the higher rate anyway. So the temporary is really just a cash flow question. But I'd rather put you into the permanent buy down where you do qualify at that start rate by permanently buying it down with that extra 20 grand, and it's there forever. So that's the way to go. Let's throw up the next slide there, if you would, for me, please. And we're going to look at the savings over 60 months. So here's the same things with the savings over 60 months. Taking the price reduction of 20 grand, you save over 60 months, 5 years. I did this on a 5-year analysis. You save $6,797. So let's just call it, $7 grand. You save $7 grand in cost savings over 6 months with the costs out of pocket spending. You don't spend as much. That 20 grand made some dent in your monthly over those 5 years to add up to $6,797. It's called $7 grand. If you do the temporary buy down, the savings for you over that same 60 months is $12,554. So that's pretty cool. You save 12 grand if you do a temporary buy down. And if you get a price reduction of 20 grand, still better than a poke in the eye, you save 7 grand. So you save 7 with the buy down, or I should say the reduction in the price of the home by 20 grand. With the temporary buy down, you save 12,500. And with the permanent buy down, you save 32,217. Let's call it 32,000. $32,000 savings. Remember, it's permanent. It's permanent. The savings per month is permanent. The savings over the 5 years is permanent. The temporary is just a quick fix. So again, we can prove through these analytics, through these quotients, we can determine that the permanent buy down is the best way to go. Let's pull up the next slide, Caroline, if you would. There we go. Beautiful. There it is. So let's go interest and MI, mortgage insurance, paid in 30 years. Now, this is a 30-year analysis. So if you just do the 30-year fixed rate at asking price, you're going to spend $692,000. If you do the price reduction of 20 grand, you're going to do $664,000. So $692,000, you down to $664 out of your pocket. If you do the 20 grand reduction, that's okay. Not really, it's 30 grand over 30 years, but whatever. And then if we do the temporary buy down, you're saving $673,000. Or what you're spending, I should say. You're spending $673,000. So again, if you do nothing, you're spending $692 in this example, $692,000. If you do a price reduction of 20 grand, you're spending $664,000. If you do a temporary buy down, you're spending $673,000 over the 30 years. If you do the permanent buy down, you're spending $528,000. $528,000 versus $673,000, or versus the price reduction of 20 grand. Clearly, the temporary buy down doesn't even beat out over time the $20,000 price reduction, but you're saving quite a significant over $100,000 over the life of the loan by doing the permanent buy down. So there's no question that when you're negotiating, we can get rid of those screens now. When you're negotiating your offer, your price on the home, leave the price up. Leave the price up and get the money to permanently buy down the interest rate, because that's really where you want to be. You want to permanently buy down that interest rate. Use the money you're getting from that seller, from that they're reducing their price down. Get them to give you that money so you can permanently buy down the interest rate. Buy down, somebody's asking the question, what is a buy down? That's a great question. Thank you. The buy down is where you're paying interest for the loan, or you're paying some money for interest that the investor is going to lose on not charging the higher interest rate. So if the interest rate is 7%, for example, the return on that investment, on that money borrowed, is X amount of money. Well, what's happening is if you say to the investor or the bank or me, Loan Depot, whoever, hey, I want a lower interest rate. Well, it's going to cost you something in discount points. Those discount points are discounting. You pay money up front to discount the interest rate down a level. So that's what you're doing. The temporary does the same thing. The temporary buy down is you're paying the interest between what you would pay at the 30 year, the normal rate, the baseline. You're paying the difference on the interest you would be paying in that first year that they're not getting from what they should get, and the interest that they're not getting for the second year that's still lower because it's 2-1 buy down. It's bought down by 2 points. It comes up 1 point the second year, and then the third year through the 30th, it comes back up to its normal note rate. And so you're paying that temporary buy down up front. And that's the 20 grand we were talking about getting from the seller. Instead, in this example of having them reduce the price by 20 grand, let's have them do a permanent buy down. So the buy down is you're paying money for the interest rate that the bank is not collecting over the period of time. You're paying that up front. So you're giving them cash to get a better monthly payment and a lower interest rate. So that's how that works. So that's where we want to go with that. So don't drop the price when you're negotiating. Talk to your agent. If you have any questions about this, how to structure this, how to negotiate it. I've been negotiating for 38 years in mortgage, real estate, and legal. And I got to tell you that there's a specific way of doing it I think is best. I also coach and mentor agents as well under the auspices of Agent Superstar. And I think that there's a way that you can come into this without confusing the seller and getting too many moving parts that they have to analyze, and keep them on track with what's really best for them. I always say I'm the first and only loan officer in the country that makes selling more profitable and makes selling more efficient. And you can do that by knowing your negotiating techniques and how you can get to that same place at the table, and a win-win for both buyer and seller. Okay, so that's that. Let's talk a couple more things. I know we're going long today. I said I wasn't going to do it, but I'm doing it. Okay. So, and again, you're listening to Mortgage Madness with Mike Hobbs. Thank you for tuning in. You can find us on Spotify and iHeartRadio, and you can find us on the podcast there. You can also find us on YouTube. You can find us on Facebook and LinkedIn, Twitter. You can find us in a bunch of different places as well, or me in a bunch of different places. I say us, I don't know why. And let's talk about being cash. How do you make yourself competitive? We may save this for another time because we're running along. I want to get out of here in a minute. But make yourself cash buyer. There's ways to do that. We're going to talk about that next week because we're running along on time. So I'll share with you next time when we have Sean Glenn on our show. She's an attorney, and she's going to come on the show with me. And we're going to be talking about real estate and things you can do to protect yourself, and all sorts of cool things, anecdotal stuff. I've got my stories from having the law firm years ago, working for Lehman Law, and we'll talk about those things. So Sean Glenn is going to be my guest next week on Mortgage Madness, so you don't want to miss that. Let's go to our last segment, which is what's up with that. It's my rant. What is up with that? What the heck? You've heard me talk about things before. Last week, you heard me talk about Finley Toyota, and I had this warranty call in for my dash on my Jeep Grand Cherokee that was falling apart. And the main office now that handles all the different companies, I don't know what their name is. I don't know in front of me, but anyway, they basically said, sorry, you're out of luck, man. Even though you came in, you turned it in, we took pictures, we turned it in, we approved it. COVID came, boom, it's been too long. And I kept checking in. You're not going to get anything. Well, I just got a call from the GM, Chris, over there today. And he said, it doesn't matter what they say. It doesn't matter what's going on. I have all the records. We see you came in. We see we took pictures. We see they responded. We see blah, 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 blah. And it's not right. It's not, we're going to take care of you. It's the right thing to do. Don't worry about it. Give me a couple more days. I'll call you on Friday. So my rant was, what's up with this? Because they weren't taking care of us. They made an offer. I accepted and they reneged on it, rescinded it, and it was just leaving us flat with a broken part on a car that was under warranty. No way. And so that was my rant last week. I'm happy to conclude that through this show and all the calls that you did to Finley Toyota, there were hundreds of calls that you listeners did for me. And it was awesome. I love it when we band together and do something like that, is what forced Chris. No, I'm kidding. You didn't do that. But Chris was just a good dude and he's doing the right thing. So I have high marks and high regards for Finley Toyota out of Post Falls, Idaho. I think he's a stand-up guy as a GM there, and they're going to take care of us. So thank you very much, Chris, for listening to the show. I appreciate it. That is the conclusion on the What's Up. I'm going to tell you, I swung over from Spectrum to YouTube and to Ziply Fiber, and cutting the tie with Spectrum was horrible. If you have Spectrum, I'm just going to tell you right now, believe them, man. Go to YouTube, go to Ziply Fiber. It's awesome. I'm talking here at my home on wireless right now and doing the stuff, and it's just seamless. I mean, that's something like 1,000 gigs or something up and down. I don't even know. It's huge. And also they're really friendly and cool. They made a little mistake in installing, and I think I'm getting a free iPad. They told me I'm getting a free something. It's some electronic device. I don't know what it is. Maybe it's an EV. I don't know. Anyway, they're giving me something free that's electronic. And went to YouTube, and it's great. Spectrum was horrible because they have a month-to-month, and I didn't know my contract. And so I canceled, and I canceled it one day late because I had to wait for Ziply to get in. And they're charging me the full bill of $250 is what they're going to charge me for the month of December, and I'm not even using it. And there's nothing you can do. And once I got into that department, it felt like typical collection agencies where they're just like, they don't care, man. The relationship is over. You're out, done. We're going to take your money and go. So my what's up with that is, that's not how they're going to continue to get better clients and things like that. And I have friends that work for Spectrum, but the entity with the television and the cable, not good. So anyway, that's my rant. What's up with that? There's nothing I'm going to get out of them. Big fat bureaucracy, and I'm not going to fight them for $250. But hey, be careful when you cut your tie and go away from the cable, which I endorse 100% because it's awesome, that you make sure you know your timing on that. Okay, we've gone long. We're 23 minutes on this thing. I'm going to wind this down and say goodbye. And you guys, I hope everybody had a great Thanksgiving. Tune in next week. I know I did. I had a great Thanksgiving, so I hope everybody did. We had our pre-Thanksgiving show. And then tune in next week because we're going to have Sean Glenn on. She's a real estate agent, and she will be coming on. So I'm going to sign off. Wish everybody well. Stay warm. Don't let the snow slow you down. If you're in California or somewhere it's warm, hey, enjoy it. I'll send me a little note and tell me how nice it is, or a picture. Anyway, that's it. I'm signing off. See you later, everybody. Thank you.